So a lot of times we think that investment returns are random, especially the stock market. People talk about if you're invested in stocks, you must be playing the market. But there's an organic relationship between different assets that you can invest in that is created by the votes, if you will, of millions and millions of people with trillions of dollars every day, essentially seeking the best use of their capital. In our country, it's been this way for a little while now, but we haven't seen this set of circumstances since 1950, and that is that you can get substantially more income from the S&P 500 index's dividends than you can from a 10-year Treasury bond. The 10-year Treasury bond, the interest once you buy that bond can't grow, and by design, the amount of principal cannot grow. So as of today, if you put $100,000 into a 10-year Treasury, it will not default, and we know that 10 years from now you will get your $100,000 back. You will also get $1,500 worth of interest each year for 10 years. That is your entire upside possibility. If you put $100,000 into the S&P 500 index fund today, you would get about $2,400 of dividend income immediately. $900 more than the $1,500 you get from the 10-year Treasury. Over a 10-year period of time, dividends tend to grow pretty consistently. So by the last year, you would expect that $2,400 would be $3,600 a year, or well more than double what you'd get the last year from your Treasury. In an average 10-year period, you'd also expect that $100,000 to become $200,000. So it takes a special amount of pessimism in the world for people to say, I do not want a third more income. I don't want any chance to grow my income. I want no chance to grow my money. I'm going to go with this for safety versus this, which starts off better, gets even better, and doubles my money. So I should explain it. So you have dividend growth that will happen, but you also have stock appreciation, price appreciation. In a normal 10-year period, the price of those stocks would appreciate to turn your $100,000 into $200,000, not counting the dividends we're talking about.
In addition to?
Yeah, in addition to. In 10 years, a little over the 10 years, at a 7% rate of return, you double your money. The long-term average of stocks is 10% or so, of which 3% is dividends. Today, it's only 2.4. And the ultimate point is, this is the math of the markets telling you the world is pessimistic. This is the point I'm making. And we know throughout history that points of peak pessimism are great opportunities over the next period of time to be invested. In fact, the opposite is also true. When everybody you know is very excited about an asset class, it's the worst time in the world to invest. Right now, misery loves company, so we know all of our friends are pessimistic. It's okay for us to be pessimistic. It feels comfortable. But I would tell you that in 2005 or 2006, in Florida, condos on the beach had never been more popular. Literally, people were buying 2 or 3 and collecting them. At some point, figuratively, in 2006, they ran out of people to buy condos on the beach in Florida. At that moment, they had never been more popular. But the price pretty much had nowhere to go but down. The converse is true now. There was so much optimism in real estate, price couldn't go up anymore. I'm not saying the market can't decline at all. I'm just saying that after 30 years in the business, I know that times of really peak pessimism are always great opportunities for the next 5, 10, 15 years. I can't guarantee that, I just know it to be true. And then the last part of that is, regardless of if this is an above average starting point or not, a starting point of an above average return for stocks, we're at Truman era interest rates today, rates that we haven't seen in maybe 60 years. There is literally no upside in fixed income anymore. And there's a bigger part to this. Interest rates have now been declining for 35 years, greater than an entire generation. So what we know as a fact of how fixed income securities behave cannot simply recur. Because 35 years ago, the 10-year Treasury yielded about 16%. Today, it yields less than 1/10 of that. That trend obviously cannot continue. But there's very few people alive that have an adult memory of what happens when interest rates rise to their fixed income securities. From 1946 to 1981, rates rose. People had a very different feeling about bonds then. They knew you bought them and you had to hold them to maturity, or else you're probably going to lose money. We've been taught in the ensuing 35 years that that's no longer true, except for we're back today at those interest rates we were at then, in the early 1950s, late 1940s. So we're back, we're going to feel 30 years from now how we felt in 1981 about fixed income, but nobody knows that. Here's what this means. Your father, your grandfather, your mother, your grandmother have never lived through this. So they don't realize what has to happen to fixed income securities. Again, if you bought a 10-year bond and it yields 1.5%, that is your entire upside. You will make no more than 1.5% if you hold to maturity, and odds are dramatically in your favor that if you need the money before maturity, you're going to lose money. So what your mother and your grandmother would tell you was a safe investment is now pretty much return-free risk. Things are turned on its ear. In my 30 years, we haven't been here before. We know if you ask a 70-year-old today, are stocks risky and are bonds safe, they would say yes to both. Because during their lifetime, they've known stocks to have volatility and bonds to have much higher interest and much more liquidity. Now we have no interest and no liquidity. So it's a whole new world on how you have to invest to meet your long-term goals. In addition, your grandparents didn't live that long after they retired. Your parents didn't necessarily live that long after they retired. Today we're planning for 30-year retirements in which we need to have growing income. You can't have growth or income. What cost you $1 in the first year of your retirement will cost over $2.50 in your last year, just counting normal inflation. If you do not grow your income in retirement, you will have a declining standard of living in retirement, or possibly run out of money. So very important things, the rules of thumb no longer apply. So I realize this might run afoul of old school conventional wisdom, but it is fundamentally how markets work. If you're not familiar with this, maybe you'd like some more information, get in touch with us. Again, I'm Michael Rogan, the founder of Rogan & Associates Financial Planners.